Alright guys, let's begin. Interesting open. So straight from the get-go you get a lot of US dollar buying. Now, if you know my style of trading, and if you've been listening to me for the last little while, then you know that I'm a bit of a dollar bear at the moment. And so I took this as an opportunity to get long. But definitely respected a little bit. Okay, I mean not too much, but a little bit. The fact is that a few Fed speakers now have come out suggesting that they will raise rates or potentially raise rates in September. But my gut feeling is that they're playing lip service, and that the reality is nowhere near ready to be raising rates. So, or the intention, the willingness is not there, and they're a little bit worried about what the market will do. And they're quite happy for stocks to remain chugging along like this, and they don't see too much immediate risk to the housing, or still got low inflation, and overall the economic stance of monetary policies better than raising, whereas unforeseen some sort of negative consequences there. Also, I mean, it's not so much that they don't want to raise rates as they haven't telegraphed it well enough to raise rates. So I had this discussion a lot with some clients today. They really want to make sure the market is ready when they raise rates. That's their main thing they're going to do these days. They want to avoid taper tantrum. So, what happened with the taper tantrum when they came close, when they just announced that they were getting out of the bonds without any really big leadway into that. Now, what I would take away from this is that if Yellen on Friday just says something along the lines of, we may raise rates in September if the data is adequate, or no, say we're getting very close to raising rates, or says something along the lines that makes it possible but not explicitly confirming it's happening, then it's basically implied it's not happening. Right, so I think the chances on Friday of there being a US dollar sell-off is very strong. All right, 10% chance of the Fed raising rates in September means that they basically can't at this point. It's too close for them to change their view. And if Yellen does come out and explicitly state they're going to, pretty much close the door, just say, yeah, look, we're going to raise rates, then it's a chance they're going to raise rates. But if she says anything wishy-washy along the lines of what she said in the previous times, it's just not going to happen. So that will leave December as the main chance. I think that's sitting around about 40% at the moment. But, it's really a bit too late for this September. So any sort of rally you get around this Fed speak where they're talking about, we can still raise rates in September. You've had a few, Fisher came out of the weekend, said that. Williams and Dudley said something similar last week. That's just, for me, that's a perfect opportunity to get long the US dollar at better levels. Right, so I'm a US dollar bear, right? So I could be wrong on this. I could be not reading the tea leaves, and so I'll be watching those US Fed fund rates futures, see if there is any sort of change in the percentage chances there. If it quickly gets above 30%, 40% or something like that, obviously I have to give in, right? And the US dollar strength will be pretty strong. But I just don't believe there is any potential here for a sharp turnaround, and that Yellen's left it too late to begin that. So that's my thesis, right? That's what I'm going with. So how does that play out during the week? Well, unfortunately, I think the market is more ready to play the range than to bust the US dollar yet. I think the big sell-off in the US dollar comes next week. Alright, so potential range trading for the next 3 or 4 days, because there's no economic data really. And then if Yellen confirms what everyone's thinking, that there is not going to be a rate rise in September, by not explicitly stating there is going to be one, then, or as close as she can to explicitly saying, then you will see a US dollar sell-off starting Friday, probably continue for most of next week. That's my game. That's what I'm playing. I'm not going to play it via dollar yen. I'm going to play it by euro long. That's the way I've been wanting to play this. or pound long. Now pound's starting to attempt a bit of a short squeeze here. It's rallying on little to no news, and it's positioning wise, it's the most stretched it's on record, right? So it's got that ammunition to start that short covering rally. Pairs which are a little bit dangerous is that the Aussie and the Kiwi have started their own little correction. Now there is a speech by the RBNZ governor tomorrow that might get a little bit of Kiwi selling. I still don't believe this Aussie sell-off, and this is a great opportunity to buy on the dip. And if you look at the Aussie dollar, it hasn't really broken any of its major levels. So in terms of what I'm in the market, I did sell, I hedged on Friday on this euro. I don't really need to be hedged there. Some stops to entry. That was a trade from last week. And the pound trade, yeah, that's going okay, but I've got a little bit of exposure here, more than I wanted. So selling dollar CAD, I'm not too upset about that. Let's sell a bit more of that actually. So you're asking how am I losing money? I bought a pound on Friday, quite high, and that's under pressure. Also, I bought a lot of Aussie Kiwi last week. Now, Aussie Kiwi is one of my favorite trades. Now, it did break below 105. Now, that's concerning. That's not part of the program. That's not what I was expecting here. So we were sort of buying along this trend. You know, it's like, yeah, market's dipping down, the lows are getting higher. But then you had this Aussie dollar correction last week that sort of negated this. So be careful when you're trading off the technicals of the straight what's happening off a cross, right? Because the cross is not the main game. The cross is just really the synthetic connection of what the Aussie's doing and what the Kiwi's doing. And the Aussie was a little bit relentlessly weak on Friday. There was this downgrade of the Moody's of the outlook to Australian banks. That's sort of following up what S&P did. Now that's pretty negative. That's pretty negative potentially if it gets to full downgrades, because the thing about Australian banks is that we get our funding offshore. There's not a big enough saving base here to get the money that they need to do their lending. So, you know, we do have to go offshore, and that means we have to be AAA rated. If we aren't anything but AAA rated, then the credit costs increase. Right? If the credit costs increase, then the banks have to pass through that credit increase to the consumers and the businesses. So there is a bit of concern about that. But look, like I said, this on the daily has done nothing but go towards the bottom end of its trend channel. So it's still, for me, you know, I'm still happy to be selling the US dollar. So definitely I'm happy to be buying the Aussie. Still a high yielder, still AAA rated, unlikely to cut again, and data's pretty strong. All right, so just broadly, yeah, it's pretty bad lines, but you know what I'm getting at there. We haven't really negated any of this uptrend at all. This is just natural pullback so far. Nothing to get excited about by the bears, and really, I mean, you have to go below 75 to get any sort of sense that the medium-term top is in place. I'm still thinking that we test 78.50 towards 80 cents in the coming weeks. Okay, so let's put those in just so we know where we're heading. Yeah, close enough. Alright, so I mean, I could be wrong on this Aussie Kiwi. Alright, Kiwi is relentless, right? The Kiwi is harder than the Aussie to sell. And I might have to reconsider this whole thesis. While it might be okay for the long run, you know, buying 2.5 lots on a 10k account is a bit crazy. Now that's, I mean, if now it goes to 103, 104, so 102, it might margin call me. That's if I don't hedge or if I don't make some money in the other pairs. Well, I don't really want to add money to protect it, right? Because this is, you know, but the other side of this is that it's never been below 101 and parity since it floated. So it's like, well, you got that on your side if you're going to go to war, but you don't really want to go to war just because you entered early, right? I mean, if the market goes down there, it'd be great buying, of course, but we're still a couple hundred pips above. You don't want to carry a big drawdown for no reason. Yeah, so it is a little bit dangerous here. I might be buying some Kiwi, straight Aussie as some sort of hedges with the US dollar. But then if the US dollar goes really strong, then you've got a double problem, right? So it's like, let's see if we let's see how it develops. I mean, probably better than cutting is hedging. You have a chance to get out of it both ways there, but yeah, hedging's notoriously difficult for the main reason that your bias still is going to be long. So you're probably going to close out your shorts too early, and if it goes up, you won't be able to potentially get out of your shorts if it starts to act as you believed. Alright, so that's the problem with hedging in a nutshell, that you can get stuck in trades you don't want to be in and not trade your way out. Partial hedges make more sense than that if you just got too much exposure and the market's done something you didn't expect. But let's just see. I mean, it did have a little rally today. If you've been watching Aussie Kiwi, and maybe many of you are, because we have one of the traders in there trading it. Kilo is pretty heavy on the long side, and so it makes sense. It's a favorite trade out there. Reports are there was some heavy buying by long-term funds down here at 104.80 on Friday. So I mean, we're not the only ones out there, but long-term macro funds don't take stops. You know, they're basically buying the Aussie Kiwi because it's at 105 and it trades between 105 and 130 99% of its life. And so they will just either add to it as it goes down, and they're not using leverage. So that's a different. You can't rely on them to bail you out, right? So really, I mean, tomorrow's speech by the RBNZ governor, we're going to see if he's still concerned, if he explicitly tries to jawbone again, and if he does, that will help us out, of course. But really, I mean, not just help us out, we need to get back, above 105.80 really quickly. Otherwise, this is looking pretty dreadful. It was looking okay until Friday, Thursday last week. But it did noticeably fail to get past that 107.50 a couple of times now. Alright, so that's the my main trade, right? I've been talking about that trade for months, but obviously we're in too early, and now we're back at this key 105 level, orbiting it. It could go into this really quiet little range again, but where Aussie and Kiwi basically keep pace with each other. My spider sense tells me it's going lower. That there's too many people on the long Aussie Kiwi trade, that it's just easy money to flush them out, then do the big rally. And so if that happens, right, you've got to be prepared for that. But the pound, yeah, I'm quite happy to remain long here. It's I think it's got potential in the coming days, and if there is a weak US dollar scenario after the Fed speech, or even up to it, then this is probably going to be the outperformer. So we'll just keep that in view in the next couple of days. Unfortunately, guys, I really expect the market to be extremely quiet this week. It's unlikely that you are going to get that heavy movement that we are hoping for as traders. There's just not the catalyst there until Friday. And then Yellen is notoriously dull. It's not in her character to come out and surprise the market with, this big hoorah. Now, there is a small chance, though. There is this small chance that she does actually the opposite. Now, what the opposite is, you probably read this if you follow any sort of macro news. I'm just reading some of these comments. Yeah, the market doesn't seem to care about the talk of raising rates. Yeah, they are starting to call bullshit. Shit, I wasn't lost my train of thought there, Nick. Don't make me laugh, mate. Okay, yeah, sorry, huge potential. maybe 10 to 15% chance on Friday that we get a speech that opens the door to a new monetary policy going forward. Now, the reason we're talking about this is that over the last 6 months or so, there's been this rise of economists around the world saying that inflation targeting is no longer the way that central banks should be carrying out their monetary policy, and what they should be targeting is nominal GDP. All right, so nominal GDP is not the same numbers that you get in the GDP that are released. It's non-inflation adjusted. All right, so back in the day, like we're talking, between 2000 and 2007, 2008, Australia was running at like 7% nominal GDP. At the moment, we're running at like 2% GDP, 3% nominal GDP. Right, so there's a huge drop in actual growth of the economy in nominal terms. Right, so without inflation. Now, inflation-adjusted GDP is, even worse, of course. But there used to be higher levels of inflation, so GDP was just running above that. We're not getting that at the moment. And so there's a suggestion that this would be the best thing for banks to do. That inflation has entered a new period in modern times where we don't have to worry about it so much, and that leave it to your own devices, and that's we're going to stop worrying about it so much. And that would be extremely dovish for the US dollar, because any sort of uncertainty brought about by, say, they're going to do a review of the monetary policy, and the timing seems a bit odd. They'll probably do that after new president, right? But the time, the Jackson Hole is when these big things are announced. Then you don't raise rates while you're reviewing, your monetary policy. So this was highlighted by the Citibank on Thursday last week. Got a lot of attention from a lot of traders saying, "Wow, this is pretty huge." It was on the basis of back of Williams hinting at something happening, but if you look closer at what Williams wrote, it's probably not further. It's probably a lot further out than just say a couple of days from now that they're going to try and change how they do their monetary policy. Interesting enough, there was an article in today's Australian press by one of our independents, Nick Xenophon, arguing for the RBA to do the same thing. So if we bring that up, I'll just get that link for you. If you're watching on YouTube, guys, come across to Forex Signals. I'll post that link in. So he teamed up with economists to write this op-ed. And right, so that is an article basically saying the same sort of stuff. That inflation is no longer what the RBA should be targeting, rather than nominal growth rate. Yeah. And it would gain a lot of traction in some of those countries where there isn't much wages growth. Because there hasn't been much wage growth in a lot of countries around the world, right? And all this easing isn't really helping the average man. So there could definitely be some popular support for this sort of targeting. So, look, my thesis is that this is going to be most likely a really dovish outcome for the US dollar, or extremely dovish for the US dollar. Any sort of attempt by Yellen to try and convince the markets that it's going to be a rate hike possibility in September is just going to fail, in my opinion. I mean, I could be wrong, and I'm going to be a little bit cautious going into the announcement, but I'm definitely going to be holding trades, short US dollar trades. So we'll see what she can come up with. I mean, knowing us, right, we're just reading way too much into it, and she just says nothing. And the market doesn't do what it needs to do. I mean, the euro here is just teasing the hell out of us. If you're looking at the longer term charts, I posted some of these to some of my clients and like, well, it's pretty much smack bang in the middle. Why are you getting so excited? You can make the sort of argument that all these, you know, rallies have been failures. I'm like, yeah, no, but it's gearing up, right? We're gearing up, breaking up top. Imagine if we break 115. And it's like, well, it's hard to get excited before it happens. When it does happen, starts to happen, maybe we can get a bit more excited. But this is really a potential, though, if there's this weak US dollar next week, right? I mean, it's pretty close. It's not that hard to get past there. Imagine if we were running into 115, right? And the NFP comes out a little bit weak or just at expectations, nothing to slow it down or change that September Fed hike or just, you know, change anything. Then you could really see this pop, you know, past that resistance, and I think we're not going to slow down this time. So this is, you know, we might get to 120 in a couple of months. So that would be fantastic, right? Because if there is some clear movement on the euro, we get clear movement on the other pairs, and it'll make the pound a lot easier to trade. It'll make the Aussie a lot easier to trade. So my whole Aussie going to 80 cents really requires the euro to go to 120. What pair that I don't really see going that much lower is the dollar yen. I don't think that the road to, I don't think that the road to 95 is as easy as the euro road to 120. But you know, I know that I've got a natural bias to be buying dollar yen, and that, you know, I've got this feeling that the BOJ is going to do something ridiculous if the market gets, say, to 98 or 97. So in that scenario, if the Fed is relatively benign and stock markets remain quite strong, I do see a chance here that we get this yen cross rally for the first time. And remember, yen crosses are extremely low. That we start to get this yen cross rally come through because of the majors rally. So how do we get an Aussie yen rally? How do we get a euro yen rally? We get these via the majors, not the dollar yen this time. Probably the rarest of all the yen crosses rallies is if it comes from the majors alone, but I've seen it before, just not in the last few years, because it hasn't been sustained US dollar weakness in the last few years. Okay, but euro yen is one to watch closely here. There's some talk there's basing, and euro yen is a huge pair, guys. It's a huge pair. I always say it to you, you know, every couple of months. It's like the third biggest pair, as big as the pound. It just doesn't get much play because it's not a traditional major, but the amount of flow that goes through in the euro yen is just huge. And pound yen, of course, everyone knows pound yen because it's like the funnest pair to trade, right? You know, the sharpest pair. It's gearing up at the moment. So if we weren't in this, potentially we should have gotten this. I don't trade pound yen. It's got me in trouble before, and I mean, you know, if I love buying dollar yen, I love buying pound yen. I just don't want to play it at the moment. It requires me focusing on the pound too much, really, to and you know, I don't really want to get involved in the dollar yen because while I don't feel like it's going to go below 100 very easily, I'm quite surprised it is as weak as it is now. So if you know that you're not reading a market well, like if you're quite surprised by a market, then you don't want to go trade as crosses. Yeah. So that's the main trade there. That we're looking to gear up. If we have to get involved here, we'll be looking at the pound yen, euro yen. CAD yen makes sense too. On multiple levels here, if oil's going to remain high, then CAD yen probably do better than Aussie yen and Kiwi yen. But let's not, you know, count our chickens before they hatch. We haven't got that major movement beginning just yet. A little bit of a nascent rally again here on the pound though at the start of this session. Really good sign here for the bulls that this is the lows are getting higher. In fact, the euro pound might be a trade to look at. Now, you know, we like to sell euro pound a lot. Yeah, this looks fine. Okay, so it's showing signs of fatigue to the top side. It's got enough room to the downside. 85.10. Alright, test 85 here. Stop might be too close, but risk reward. Alright, so we're a little late to this trade, but it makes sense that at the moment, right, both are going to go the same way. Just the pound's going to go faster than the euro. Alright, let me check if there's any questions before we go look at some research, guys. A little bit wordy, this whole Yellen thing. Clients don't really want to talk about it too much. Gold. Alright, well, gold in theory should be a good buy on the dip here. Now, it's actually behaving quite weak though. During the Asian session today, there was a stop loss run. It might not want to play nice with the rest of the pairs. Yeah, look, I don't really want to be buying that. Just straight up looking at the chart, I don't want to be buying that. But theoretically, right, it does make sense for us to be buying if you believe that the market's going to start to price out Fed action this year. It's just the price action on gold is extremely bearish. Now the key level obviously is at 1300. If we break this 1330, but every time we go down, it's like, well, let's maybe see what happens if we take some stops out of below 1300. There's not much room. There's not much support there underneath that. You have to go quite a ways way down. So yeah, maybe we just sit on the sidelines, and if the market does, give us a really good level, we can consider it. But at the moment the price action is bearish and the US dollar is quite fragile. It doesn't make sense that it's doing so poorly. So it's one that I'm gonna leave alone. There's an argument always when you're trading: is it cheap or weak? This feels weak, not cheap. Yeah. So yeah, look. Some of you might play gold for a living and see something I don't there, but I don't. I know that Hands is buying, I believe, and I can understand why. I just and hopefully it works out, and it probably will. I mean, gold's crazy, right? We could be sitting here in a couple of days and it's 1360. It's like, oh, why don't you buy that? Yeah. It's definitely seems to be trading a little bit differently than some of the other majors. I mean, quite big pullback last 2 days. Oil, look, I mean, oil has to have a pullback, given that it's rallied so sharply. Now, how sharp the pullback is, it better hold 46. In theory, this means that we shouldn't be in the dollar CAD positions at the moment. That dollar CAD might have a further pullback, but with oil, so just naturally with oil. But we'll watch this closely over the coming days. I mean, really, if it does hold down the bottom there, then on oil, and it always just starts to be stronger, we'll add more CAD. If oil rolls over, then we'll get out of the CAD. We'll take stops. It's going to be part of your trading. You're going to take some stops 30% of the time. But really, that would be a really good opportunity as well if the market comes down to 46.50 or something, and then bounces back up to 48, and the Canadian dollar is still mucking around, going into Yellen, then we'll be looking to add to that trade. You know, even if we get stopped out. Let's have a closer look at the dollar CAD though. We made so much money selling this baby that maybe we're blinded to the potential. Surprised to see it back above 130. I would be I think it would require a big sell-off in oil to get back above 130. So this is a decent bounce, guys. This is a pretty decent bounce. You're not selling early, really. I mean, it's justifiable to be selling down here if you're bear, that is. Thanks, you big riverman. I mean, it's quite good to do a review like this. It's even though I do a fair bit of this stuff at my job, I don't go into each pair in depth over like half an hour to an hour. It does help me cement my views, and sort of give me a pause out from my thoughts, because in a very real way, if I have to be held accountable to the way that trade ideas develop. And if you see me, get into trouble with the trades, like literally like the Aussie Kiwi, you've seen me talk about buying it for the last 2 weeks, continues to fall, at some point you're going to ask him, well, Mr. Trader, what are you going to do when the market goes against you? And B, where's your stops? A, what are you going to do? B, where's your stops? So, this could be the situation coming forward where you're going to find out. Do I have the ability to close out? And I do. I know that I do. That's something I've been working on a lot the last couple of years. It will be very grudgingly, though, on this particular pair. But just generally as well, I mean, it does also allow you to hold trades longer, because if you say that you're targeting a key level, and if you close out early, people will be like, why'd you close early? So there is this accountability. You guys are helping me trade better in a way which is not directly responsible for your trading. Okay, so it's like back in the day when I was a signal provider, if I fucked up, it directly hurt you. Whereas this way, if I fucked up, it directly hurts me. There's a bit of a difference in who owns the loss and who owns the gains. But it is, I think it's a good medium here. Something that Nick has caught on quite well. Could be the future. Something like this, or something a little bit more advanced. Definitely, I think is where the market's heading towards, and it should be very interesting going forward. There's definitely a lot that can be done. Imagine if you had 24 streamers a day. It would just be crazy. Alright, so what's Deutsche Bank got for us today, boys? Anbar saying that's a big bet. Yeah, that's a huge bet. I mean, I don't even remember putting that second trade on. But if you remember, I did have that big business lunch on Friday. So, that's probably something I did. Something I did that I didn't really want to do, in hindsight, right? Thank you, Drunken Tony. He probably came home and saw that little bounce. I know him. I know him well. So yeah, I mean, this gets down to the low 104s. We've got a serious problem here. I mean, it's okay right now, but you know, there's actually too much exposure from all the other pairs as well. So I need to get out of this pound, or minimize that pound, and close out a few other pairs because there's a fair bit of exposure to the pound. Euro's looking okay, but this is way too much. You shouldn't really have more than 2 lots open. And even 1 lot is arguably the level that you're thinking. It must have cut me off mid-rant. I don't even know where I was at when I cut off. There's this new little button, and when I'm clicking through my charts on the other screen, I have the Forex Signals page behind it, and there's a button that we have to stop streaming at the moment. That I must have clicked by mistake. And yeah, no. So basically, saying that this is way too much exposure. Just generally for an account. Now a lot of it's pound exposure, pound long exposure, but also way too much exposure against the Kiwi. So yeah, I need to pare back that, and that's what I'm going to try and do next couple of days. I don't expect huge moves anyway, but yeah, you shouldn't really be more than 1 lot on a 10k trade, on a 10k account. So 2.5 lots is that's silly. And it always happens on the trades you believe in the most. It's like asking for a way to lose money is to believe you trade too much. Yeah. But it is what it is, and that you'll find that out. If you just started trading, you'll see that happen a lot. You really believe in a trade, that's the ones that will get you. Hopefully that's not the case here. I don't need to learn that lesson again. I've learned that 20 times. But it's the only way to really over leverage is when you can't see the downside. You can only see the top side, right? That's and the market really can continue way further than you expect in nearly every situation. I remember when Aussie was up at 110. This is Aussie against the US was at 110, right? Aussie's now at 0.777. Now, when the market broke past parity for the first time, people were like, "Oh, won't get to 103. Let's sell now." I saw huge losses as that market rallied to 110. It was fairly relentless to the point that we were talking 125, literally talking 125 when we're at 110. All the analysts, and that's how ridiculous it can get. So let's have a look at research though. That's Can the Fed pull off a dovish hike? I don't think so. Let's see what they have to say about that, though. Street Smirks asking me in PM, any input on the pound strength? Yeah, we've talked about the pound a fair bit, mate. It's looking very strong, and it easily can break to the top side here. It's the pair which is most geared up to break to the top side. It's the most oversold and the most stretched positionally, and we had that really strong data, and we're getting rallies on the back of nothing. You know, today we got a rally on the back of nothing. So keep an eye on it. If you're selling it, be very careful. Because when it rallies, right, it'll just go, you know, bang. Relentless rally, 100, 200, 300 points over the space of 3 or 4 days without giving you a chance to get out. No pullbacks. That's the nature of the pound. So the first point is very important. Has the Fed bought optionality on the September meeting? If buying optionality involves raising the market expectations of a rate rise to the point where the Fed can, if desired, raise rates without significantly surprising the market, then based off the Fed fund futures so far, this has been a failure. That's what we were talking about before earlier. They haven't got the situation where really they can raise the rates, even if the next NFP comes in super strong. The market would be too spooked. Can they cut and be ultra dovish? Probably not, given that the market's only priced in this two hikes for the next, you know, sort of 15 months sort of scenario. If they surprise hike now, yeah, they're true. The market will go, well, we don't know what the Fed's doing anymore. Maybe they're going to raise aggressively 3 or 4 more times in the next, you know, 2 years, and that would get a big move in the bond markets and a huge move for the US dollar. They do have a sort of good point here that the US dollar is not as strong as it was, so raising rates would not have a huge impact on the market, and you'd get the euro down below 110, dollar yen back to 105, Aussie back, you know, 73, 74. So they do have a good point there. Worth considering, but I don't think that's enough, right? Because, you know, if they let the US dollar sell off until December, then they're going to have extremely high level from which to strengthen the US dollar. You know what I mean? Like, there'll be 120 on the euro, and then they start to raise rates either December or early next year. Then you can go from there all the way down to 105 again, relatively slowly. You know, makes a bit more sense if they let the market actually swing against the US dollar first. So there isn't this overshoot of the US dollar strength. Well, I mean, we'll see. We'll see on Friday, but interesting article. Alright, we're going to finish up with this, guys. I don't want to keep you away from the market too long here. Let's see if I can find a technical one there. Oh yeah, we'll look at the Credit Suisse text. So they're looking to buy as long as the market doesn't go below 112.50. They're pretty remaining bullish. Stop at 111.50. Dollar yen. Look, I'm not surprised by this rally after the BOJ corona, but they, what they've said is that they're having this review of monetary policy over in the BOJ, with the government as well. Now they need to come out with something concrete, right? They can't fail again. If they fail again, it's just asking to go to 95. So they have to actually do something. I'm not sure what they can do. It's really hard to be a Japanese central banker. If your job is to weaken the yen, you fail pretty hard. I think it's more than any other bank that the people just don't take them seriously. They talk too much every day. They say they're watching the market, the FX market. Stop talking. Start intervening. Scare the bears. I know that goes against a little bit of the G7 pact, the G20 monetary stability pact, and things, but I mean, just do little ones, right? 300 points here and there. Make people scared to be short dollar yen near 100. Aussie dollar, that's one I'm pretty interested in here. Right, so they're looking at support at 73, 75.30 to 20. I mean, that's basically where the support and the trend line comes in as well. It does make sense to be buying down there to me. I don't know, given that I've got so much exposure to Aussie Kiwi, whether I can buy any more here. But if I had less exposure, and I might by the time it gets, if it does get down there, then I might look to be buying. I mean, if you're a buyer on pullbacks, this is the pullback you're waiting for. When you're wrong, you'll lose 100 points. When you're right, you'll make that 200, 300. And it's not really your job to guess when the trend is ending. I mean, if you want to make trading simple, right, you just follow the trend, buy off the key levels, and most of the time it's going to be okay. But yeah, you can wait a couple of days, see that there's buying, in the low 75s or in 75.50, and then if the market gets back above 76, that gives you a little bit extra confirmation. That's another way of doing it as well. So in that game, it's actually safer for the market to go down, then back up before buying, than buying right now at the same level. What are they suggesting here for the dollar CAD? So it did break the trend line. It's looking pretty bearish on most angles. Ideally, they're looking for 129 to 168 to cap. Yeah, they're pretty much in line. So these technicals are in line with my outlook here, based upon the oil market and what the US dollar is going to do with Yellen. So I don't mind this pair as well. It's great when the technicals and fundamentals line up like this. This is what you want. This was actually written when I was at 127.80, I believe. Okay, so you know, it's bounced back to 129.30, which was what they suggested we might cap. So it is pretty good levels. Alright guys, is there any pairs that you want me to look at? If not, I will be back tomorrow, 9 GMT. We'll go through the market, see what's happened. I don't expect too much fireworks this week, but keep an eye on, close eye on things. Alright, trade well, trade safe. Good luck.